All right, everybody, welcome back to Price Analysis, a fundamental approach to the study of commodity prices. This is Chapter 5, where we cover how futures markets help to transform prices over space and time. So the first concept that we want to cover is this prices over time issue. And let's just start out with some terminology. We've already used this a little bit when we were just discussing futures prices in general. But the first is the concept of a nearby futures contract. The nearby contract is the contract that will expire next. And then we talk about the contract that will be expiring first after that. So there's the nearby contract, then there's the first deferred contract, then there's the second deferred contract, and so on. So right now it is September 2017. The nearby contract is the December 2017 contract. The first deferred is the May 2018. The second deferred is the nearby contract is the December 2017. The first deferred is the March 2018. And the second deferred is the May 2018 contract. And all of those contracts that represent prices at different points in time make up what's called the forward curve. And we've talked about a little bit already how the forward curve gives us specifically information about market incentives to store. So for farmers or other stockholders, they can look at the forward curve and say, is it worth it to me to store my grain to a future date? For example, they could, if they see incentives to store that they think are worth it, for example, the price of the March futures contract is significantly higher than the price of the December futures contract. Instead of hedging with December, they could hedge with March, put their grain in the bin until March comes, and then sell their grain somewhere near the March expiration, and they will have guaranteed that return to storage. Now, the reason that the market has to offer incentives for stockholders to store is because it costs money to store the grain. It has to go in a big warehouse. It has to be put in under certain conditions where it won't rot. And all of those things require a financial investment. So these are 7 of the most commonly listed ones. I stole this from a publication by Iowa State University Extension. You can find it here. Click through and see the good work by the folks over in Ames that talk about these storage costs in more detail, but we'll just list them here. First, there's the opportunity cost of money. If a farmer doesn't sell at harvest and they sell later, well, they could have sold at harvest and done something with the money. So there's going to be an opportunity cost of that. This one isn't a financial cost that you can calculate, and it makes predicting farmers' decisions to store really hard because it's hard to know how big this opportunity cost of money is. And if it's really large, the farmer may decide not to store when the market looks like it's providing pretty ample incentives to store. So that one's kind of a wild card. The rest of these, we can get a pretty good handle on what those costs will look like. So the first is interest cost. So when they defer their sale of grain, they probably are going to need to take out a loan to meet costs of living and costs of doing business. And the interest on that loan to make it until when they actually sell their grain is a financial cost to them. They probably have to pay storage fees to the elevator where they're storing it, even if they have their own storage space by having bins on the farm. Those things cost money. So just buying or renting the physical storage space is a financial cost. Sometimes there are drying costs. Sometimes grain that's harvested comes out of the field that in a state that's too wet to put it directly into the bin, and so it has to be dried first or dried before it's left. And it costs electricity and fuel to run those dryers, and if you bring wet grain to the elevator, they're going to charge you to dry it. If you store your grain at home, you better have a dryer to make sure it's appropriately dried before you put it in your own bin, or you'll suffer severe quality loss due to that. Another cost to drying is shrinkage of the grain. So on one hand, you're going to have to pay the electricity and the fuel to run the dryers, but when you dry it, those kernels are actually going to shrink, and you'll have less bushels after you dry it than you did before. And that's a financial cost to you because you'd like to sell more than less. Another thing that can happen is quality can deteriorate. This can happen if the grain is stored for long periods of time. That's usually not the case. Farmers and other stockholders are usually holding it less than a year just to try to market their grain for a price that they see favorable. But if they're not put into storage under the right kind of conditions, then quality can suffer, and anyone who's buying your grain from you will penalize you for that. And the last one that we've listed here is cost of handling. It costs money to get these things in and out of bins in terms of labor and trucks and all kinds of stuff. So there is some cost associated with that. If you click over to that Iowa State publication, they calculate that it's roughly 45 cents per bushel from storing until March, and storing till December costs about 30 cents per bushel, and that would largely be made up of these kind of fixed costs of drying and shrinkage. And so it costs 15 cents extra to store till March than to store until December. So if you think about that, just this back of the envelope calculation, it's going to have to be getting close to 15 cents per bushel for farmers to consider storing their grain until March. Otherwise, they'd just as soon sell most of it right at harvest. Okay, let's look a little more closely at forward curves now. And this chart shows the actual forward curve for prices that were trading on September 26, 2016. And you see a nice upward slope shape there. And that tells you, you look at a forward curve like that, and you already know that there is probably ample supplies in the market. Stocks must be plentiful because the market is providing some incentives to store. It's not super easy to quantify those incentives looking straight from this graph, but you can sure get a good feel for it just by the shape. So the way we talk about markets like that is we will call it a carry market or a contango market. Both of those words mean that the forward curve has an upward sloped shape. And if the slope is really steep, we might even say that the market is in full carry, and that pretty much means that farmers are being provided ample incentive to store and encouraged to keep grain off the market. The next chart that I'm showing you here is about a year before the previous one, so September 25th, 2015. And I wanted to show you this one because unlike the previous chart that had a straight line all the way up through the September and December months, in this case we see a dip in the September and December prices. And that's caused by the fact that we start having harvest happen in September, and especially October, November should be finished by September. And so oftentimes you'll see this dip at the back end of the forward curve, or whichever dates correspond to harvest, because the market is asking you to get rid of your grain before we get into the next harvest season. And if you try to keep your bushels in storage when everyone else is bringing new grain in to store from the next crop year, you're going to be penalized for that in the market in terms of a negative return to storage. Okay, let's talk about the opposite of an increasing forward curve, and that's a decreasing forward curve. So we're going to look back to 2012 for this example. You'll remember that 2012 we had a big drought. We talk about it a lot because it illustrates a lot of concepts that we'd like to talk about in the case of a short crop and what happens to prices on that. So let's take a look. We're going to look at the forward curve at a couple different points in time in 2012 and see what the forward curve looks like as it's starting to realize we're in a big drought. Now here you see we went into the 2012 growing season in a little bit of a tight stock scenario, and you can tell that because already at the front end of this forward curve there is negative returns to store from May to July. So that tells me that we were kind of starting to run out of the 2011 harvested crop, and the market is begging you, please get your crop to the market before July because we're going to start charging you a negative return to storage until then. And then you see this phenomenon that we talked about before where as of April, the market was expecting a big increase in supply that was resulting from the 2012 harvest. And that's why you get this big dip in the fall expiration months of that year. Okay, so let's take a look at this chart on August 1st. Now, we have to introduce a different concept at this point. So we said that when the forward curve is upward sloped, we call it a contango market. In this case, when it's flat or even downward sloped, you call it an inverted or backwardated market. And we start to see that happening as of August. So as of August, we've already been through a really hot and dry July, and we've had no rain, and everyone is starting to realize that we're probably going to have a significantly short crop in 2012. You see that here in the forward curve. There's no incentive to store being provided on the board, and it's flat all the way through the next through this marketing year, and it doesn't turn down until we're expected to get some relief from the 2013 crop. So that's what it looked like on 8/1. Now we're going to take a look at the board as it was on December 2012. Now you'll see we've lost September because it's expired, but we still get this same flat shape on the forward curve, and that's providing 0 or negative, modest to 0 to negative returns to storage in this case. So classic forward curve in a tight stocks scenario. All right, so those were some examples of some real actual data. Next, I'm going to show you kind of what the dynamics of these changes look like, and I'm going to show you that with some hypothetical data so I can show you kind of the classic shapes. So it doesn't always happen like this, but this is often what you'll see if you get several days in a row of price increases or decreases. This figure that I'm showing here is an example of prices increasing. You see on day 1, the forward curve has a nice upward slope shape. We're in contango. It's a carry market. And on day 2, prices have spiked a little bit. But you see more responsive on the near end of the forward curve than the back end. The price change in December is more than the price change in March, and that's more than the price change in May. And that's pretty typical of what you'll find on most days when there's any significant kind of price move. You'll see the front end much more responsive than the back end. And then I illustrate this sort of 4 consecutive days of price increases, and I actually illustrate here the market going from being in contango to being in backwardation. By day 4, we've had such significant increases in prices that we've flipped over the shape, and now it's an inverted market, and the market is providing clear disincentive to store, and it is signaling that there must be some kind of a short crop or stock out situation. Notice again, through this whole situation, we've got prices changing more on the front end than the back, and you get this kind of shape where prices they don't have to be pinned down as much as I've illustrated it here, but they're kind of fixed at some long-term expectation, and then the front end is moving around a lot. And the only thing that would change the back end is if, notice how this is September, if we have some reason to believe there'll be some change to the crop expectations in the next year. We usually don't have that kind of information as of November of the previous year. So that's why you don't see a whole lot of movement on the back end, but you can see a lot of movement on the front end. Okay, now this example is the opposite. We're showing also beginning with an invert with a carry market where the forward curve is upward sloped. But here we're illustrating 4 consecutive days of decreasing prices. And here you see as prices are decreasing, our expectations about stocks are that they're becoming more and more plentiful, so prices are having to go down. And you see that the returns to storage are getting bigger and bigger on days 1 through 3. And that's being created by the fact that the price decrease in December is more than the price decrease in March, which is more than the price decrease in May, and so on. So this slope is getting steeper and steeper on days 1 through 3. Now on day 4, we're illustrating something a little bit different. There's this concept of full carry that we mentioned before, and that is that once the market has provided enough incentive to store that everybody's decided to store, then these slopes can't really move any more than that. Once we reach full carry, you'll start to see this forward curve move down more in parallel than it does before we've reached full carry. So I've illustrated that on the change from day 3 to day 4, and the price changes in the December contract, March, May, July, and September are all equal. It's a parallel shift down in those two lines, illustrating that the market has achieved full carry and needn't provide any more return to store as prices continue to